Taking a $20,000 401k loan seems like a no-brainer when credit cards charge 21% interest. But here's what most people miss. That loan could actually cost you $12,000 to $15,000 in lost retirement savings. Today, we're breaking down which strategy actually costs less and when a 401k loan makes sense. Let's start with the interest rate comparison. According to the Federal Reserve, the average credit card is charging 21% APR as of February 2026. Meanwhile, 401k loans are typically priced at the prime rate plus 1%. With the prime rate sitting at 6.75% as of December 2025, that puts 401k loans at around 7.75% to 8.75%, depending on your plan. Here's a real example. You have a $20,000 credit card balance at 21% APR. If you only make minimum payments of 2%, you're looking at over 10 years to pay it off, and you'll accumulate $29,000 in interest charges. Your debt nearly doubles. Now take that same $20,000 as a 401k loan at 7.75%. You'd pay only about $4,200 in interest over 5 years. On the surface, the 401k loan looks 85% cheaper. But, and this is critical, that's only part of the actual cost. Here's the trap. The $4,200 in interest is only what you pay back. The real damage happens invisibly. When you borrow $20,000 from your 401k, that money stops growing. Let's say you're 45 years old with a $200,000 401k balance. You take a $30,000 loan to pay off credit cards. You repay the loan over 5 years, paying about $4,200 in interest. Problem solved, right? Wrong. Fast forward to age 65. That $30,000 you borrowed, if it had just sat in the market earning a historical 7% return annually, would have grown to approximately $147,000. Instead, you have nothing. The permanent hit to your retirement savings from lost compound growth ranges from $12,000 to $15,000 on a $30,000 loan. That's the real cost. It's way more than the interest you paid. Here's the good news. 401k loans aren't taxed when you take them or repay them. You're borrowing from yourself, not taking a distribution. But there are huge strings attached. You must repay the loan on the IRS schedule, usually within 5 years with quarterly payments. If you miss payments, the IRS treats the unpaid balance as an early distribution. That means income tax at your ordinary rate, plus a 10% early withdrawal penalty if you're under 59.5. Even worse, if you leave your job, most plans require full repayment within 60 days. If you can't pay it back in that window, you default, get hit with taxes, and face that 10% penalty. For someone between jobs or considering a career change, this is a serious financial trap. So which strategy actually costs less? The aggressive credit card payoff strategy, paying way more than the minimum, might surprise you. If you commit to paying off $20,000 in credit card debt within 2 to 3 years, your interest cost is only $3,000 to $5,000. That's similar to the $4,200 401k loan interest. The difference? You keep your retirement savings intact. You avoid the $12,000, $15,000 compound growth hit. You don't risk a sudden repayment obligation if you lose your job. The aggressive strategy requires discipline, but the total cost, when you factor in everything, is actually lower than borrowing from your retirement. Now you've seen the full picture: the interest rates, the hidden costs, and the job loss risks. The real decision comes down to your specific situation, which we break down in detail in the full article. Head to the link in the description to read more about when a 401k loan might actually make sense, plus all the sources we cited. If this helped, subscribe for more grounded personal finance content that cuts through the noise. Thanks for watching.